Okay, so today what I'll do is I'm going to change the profile a bit to someone who's probably a little bit more of a fitting profile that will be sitting out here in the Middle East. So obviously recap, you do the fact find, you kind of recap and you kind of highlight a couple of key points or probably areas of concern, however you want to put it to the client. Okay, so there's obviously different disturbs you can do, but today I'm going to focus on a retirement disturb because typically it is going to be the most common one that you will come across. So after like I said towards the end of that meeting, I say to clients, look, whether you're 30, 40, 55, 64, a value add from a financial advisor to you as a client is to do a retirement calculation. So, Sarah, John, whoever, you're currently 50 and you've said you want to retire at age 65. You've mentioned to me that you need £2,000 per month just a moment ago so that you can live in Bali and live the life that you want to live. So, I've got one question for you. Do you know how much money you need in a pot, across pension pots, whether that's cash plus pension plus investments or all in a pension, whatever the setup is, liquid assets that you can draw funds from? Do you know how big the pot needs to be so that you can efficiently draw this out on a monthly basis? Yeah? Make sure you ask that question. Again, you know, sometimes getting a client to say, no, I have no idea, is so much more powerful than just saying, okay. So again, there's a massive difference sometimes. Again, if you're on the phone speaking with people and asking them a question, listening to their response, when you're pitching someone for a meeting, it can be so different to just blabbering out a load of information. It's really important to say, look, do you know how much money you need? Instead of going, okay, so you've got this, let me tell you how much money you need. Yeah? Hold back, actually ask them the question. Let them say, I have no idea. Okay, so, and like, I always have a joke, don't worry, it's a bit of a weird question, right? Whenever I ask that question, no one knows. It's not something that you really kind of calculate, you know, that you know off the top of your head. I'd say 1 in 20 to 30 will come back and go, and they'll know the figures spot on, which again is perfect. Yeah, so once you know how much they need monthly, what I'd say to clients, it's actually really easy to kind of almost reverse engineer what you need in a pension pot. So by you telling me that you want £2,000, that equates to obviously £24,000 per annum. Okay, so when I've got what the annual income, your annual desired income is, I do one thing to this figure for 2 reasons. Okay, so I will times this by 20. Yeah, so for the first reason, I just think it's almost a bit of a psychological thing for you, this client, that let's get 20 years worth of retirement together. Yeah, you said you want to retire at 65. Average life expectancy at the minute is 84 to 85, and that goes up, they say on average, by 6 months every 2 years. Yeah, so we're living longer. Yeah, let's plan for a 20-year retirement. But the second reason is from more a financially minded perspective, because if you tell me right now, Niall, I've got 480k in a pension pot. How much can I take from that efficiently? I'll say, well, rule of thumb is that if we can grow this pot by on average 5%, now we know that it's not going to go in a straight line 5% every single time. Yeah, some years you're going to get 3, some years you're going to get 6. There's going to be a time in that 20-year period, 15-year journey, however long it is, that you're going to lose money. It's probably going to be 2 or 3 years that you're going to lose money. But if you can average out at 5%, that equals your annual income. Yeah, and it's really important that you're trying to live in this area, because if you try and adopt this strategy, yeah, the chances of your money outliving you are considerably higher than you outliving your money. Yeah, we all read the papers, aging populations, yeah, elderly people back in Europe, back in the UK, back in the States who can't afford to pay utility bills. That's because they haven't undergone proper financial planning in their lifetime. Yeah, if you just have this in cash and you're drawing from it, yeah, there's such a high probability that this pot will deplete by the time you're 75, 80, 85. Okay? So really, really important that we try and adopt this strategy. You know, if we think about it, right, you know, you're currently 50 years old, okay? You said you want to retire at 65. You know, we'd hope that your income is slowly increasing like that. But then when you get to your 65th birthday, sometimes not even out of choice, sometimes you actually can't work. My father needs his hip replacement. He hasn't been in work for the last 4 months. Yeah, he actually physically can't work. As you get older, there's chances that you're not going to be able to physically work, and that income is going to stop, and you're going to be left with your pot of money. Yeah, the investor one who just doesn't adopt this strategy, that money's going down. It's going in one straight direction. Yeah, whereas the investor that tries to adopt this strategy is far more likely to have longevity in their funds. This is where we want to be aiming for, not here. Yeah, it's really, really basic stuff. Yeah, again, and it's not to say that if you don't get this figure, you're not going to be able to do your retirement, but let's aim for this. Yeah, let's at least try and put some things in place in which that we can try and adopt this, because if you aim for this and you've got a target and you miss it by 20%, you're still going to be far better off than if you hadn't put any kind of process or any thought into it at this stage. Really, really important as well is the client, and I use this diagram for every person that I deal with, right? This feels like a mountain, yeah? Your current net worth is only 300k, yeah? You're 50. How are you going to accumulate all that fund in 15 years? Yeah, let me tell you right now, there's a flag at the top of this mountain, yeah? And you need to get there when you're 65. Yeah? You are currently here. Right? So it's a fairly steep journey to the top. But if you leave this for 5 years, that's going to be getting steeper. Similarly, if me and you have been having this conversation when you were 30 years old, guess what? It would have been a lot shallower incline. So it's really important that you just get something going. So, there's one thing wrong with this figure. Raoul, what is it?
And it's not adapted to inflation.
Yeah, correct. Brilliant. A lot of time the clients will be like, no idea. That's today. We all know that £2,000 20 years ago went considerably further than it does today. Yeah, everyone knows that. Inflation's a big topic. It's on everyone's everyone's tongue. Really, really important that we need to factor in inflation into this figure here. So obviously, you'll have one of these. If you don't, go and get it. Rian we'll sort this out. I'm sure we've got spares. You've got an inflation calculator here. So what we're going to do is you get that figure, and always, I used to have an actual big old school calculator. I would pull this out immediately. Okay, and I would sit down with the client and say, we're going to use 3%. I know it's a little bit laughable at the moment with some of the inflation rates we've seen over the last 18 months, but if we get 480,000 and we go down to 3% over 15 years, we're going to times that by 1.55, which actually gives us an end target of £740,000. This is the end figure. That's going to be able to pay us £2,000 in today's terms. Now, feels horrible, I know, but you've got two kind of different investors here that are going to get to that figure. You've got investor one, which is probably what you've been doing. Yeah, you've got £80,000 in the bank here, very little investments elsewhere. You've just been hoarding cash, haven't you? So, let's just say we're going to adopt that for the next 15 years. We're going to get the 744,000. We're going to divide that by 15 years and divide that by 12 months. And that gives us a monthly saving target. Brilliant. Only £4,000 to save at 100%. Or we've got the second investor. This investor's taken financial advice. Okay? So on this figure, we're going to work off 5%. What happens to the investor that invests every single month, and like over here, he averages 5% year on year over the next 15 years? Well, let's have a little look. So 744, I've got my magic growth rate here over 15 years. We're going to divide that, and sometimes I pass the calculator to the client. Right, whip this in. 740 go to 15 over 5 years, divided by 23,591. We're going to times that up by 100. That investor saves considerably less. Be this investor, not this one. Really important that you're getting your money in the market, because it makes that journey up the mountain considerably easier. Does that make sense? Sometimes when you've bought into a client, I remember I've done this for a couple of doctors. Some doctors, because they're high earners, I think it's really good market for anyone to go at. Sometimes they look at that and go, well, that's what I need to save. And they've got £10,000, £15,000 disposable. They're like, perfect. Come back to me with that. Let's do that over 15 years. That, all of those diagrams, goes on that page. So you can see I was doing it for Mike the other day. Yeah? Everything goes there. The more busy this page is and doing all of those diagrams, the better. Engage the clients more. If you just go to someone, oh yeah, you need 2,000 quid. Well, basically, you get your annual, that's 240 grand, 24k, times that by 20, and then you can just grow it. Whereas if you're going and speaking about it in the nature that you are there, you make it easier for the client to understand. Okay, so we've got our target. We understand that we want to be getting growth. We understand that we want to be living in this area. Have you got any questions on anything so far, Mr. Client? No. Okay, so I think, like I said, we've gone through the fact finds. You just need to start something. Okay? So, it's a throwaway, guys. You're like, well, this is just basic stuff. Of course we do this for clients all of the time over here. And the reason being is because we don't have pension plans in place. Now, let me tell you, Mr. Client, I actually don't like pensions. Typically, if I'm working with clients who are really interested in saving money and actually trying to hit targets. Because those clients will not be accessing their funds, which is actually a really good thing about pensions. Yeah, they're locked away. You've got no access. For us, we prefer to use Isle of Man savings plans. Over the long term, they can be a lot more tax efficient for clients, but also you know, you've got different features of them in terms of like, you know, you've got flexibilities around what you put into them. Do you want to like have a little bit of a break? You know, with your pensions, if you're in the UK, US, you can't go to your employer, stop my pension payments for 6 months, please. I need a little uptick in my income. You can't do that. It's all automated. You just see your pension money coming off, and that's that. You can sometimes reduce it a little bit, but a lot of the time you can't. It's set from it's set, especially in the UK at the moment. Okay, they made it a lot more stricter about in 2000, and I think it was 11, in terms of really making sure that it was mandatory for all employees in the UK to be paying a certain percentage as a bare minimum into a pension. So what I'm going to do is I'm going to take you through an Isle of Man savings plan and just show you some of the features. So first couple features, I would just refer to them as basics. So really good feature about these is that these are multiple currency, or you can set these up in whatever currency that you want. So you might want to set up in US dollar. You can have exposure to sterling or euro funds within that, if that makes sense at the time. But we can choose and elect what currency you pay into. So Raul, you've told me that you're retiring in Bali, yeah? You're getting paid here. I feel like US dollar is the best option. Similarly, got someone going to Europe, someone you got going to UK. Yeah, you agree, probably best to save in dollars, right? Yeah, okay, happy days. So the way you pay into these, yeah, you've got a choice. Yeah, two main ones. You used to be able to do checks, but they've stopped those. You can do a credit card mandate or bank standing order. Let me tell you right now, Mr. Client, 90% of my clients, I really encourage to use their credit card for a couple of reasons. Number one, if you give the banks an opportunity to mess up a overseas transfer, they will here. You tell a bank here, send $1,000 to this account over here, you'll always get 985 because they're like, oh, there was a fee in the middle. Yeah, give them an opportunity to mess something up with a bank standing order, they will. Credit card is really automated, but more importantly, this can collect people some significant points. I've got a couple of clients who cover business class flights home just on the points of their savings plans. Yeah, credit card. But if you want to do bank standing order, that's fine. Last basic is you can choose the frequency. So you can have annual, biannual or monthly contributions. You've told me that you want to set up like a pension style savings plan. So, you know, it's up to you, but I take it you're going to be like a lot of my other clients that your salary comes in 26th, 27th of the month. Let's collect this first of the month. Yeah, okay, monthly. I always prefer this one because we can start to build it into your fixed costs. Yeah, there's no, okay, how much am I going to be saving towards my retirement this month? It's like, right, my rent's that, my utility bill's that, my living costs are that, my pension's that, my phone bill's that. Yeah, it's just built in. This is just a fixed cost. It's to take out of that account at the beginning of the month. Okay? The next kind of points kind of revolves around the ongoing levels of flexibility, because these are a little bit flexible. Yeah, they're not totally flexible. You've got to be strict. These are disciplines. These are for serious investors. Yeah, but there are elements that the plans have within them and features that allow you to be nimble and move around, you know, the monthly payments based on your current circumstances. So number one is you can increase and decrease contributions. At the moment, you might be able to save in $1,000. But let's say in 4 or 5 years, yeah, you get to the age of 55, you get a big job offer in Spain, or you get a big job offer in the UK. Then you're going to get re-enrolled into a pension scheme, but your disposable might come down. We can bring that down for a little bit. But then I've seen over the last decade here in the Middle East, what you tend to find is investors will go back into taxable jurisdictions, realise that it's absolutely horrible over there, and then they find themselves back in a senior role out here when they're 60, 62, couple of last years, bolt on some good income to speed up that retirement day. So when you go back to the UK, you might go, no, I can only afford $400 a month now, or 500 or 600. We can bring that down. But similarly, when you get to the end, like you've got 2 years left on this, you've seen the wealth build up, your fixed costs go down because the kids have flown the nest, you can ramp this right the way up to $4,000 a month if you want for the last couple of years. So you can go both ways, and it's really important, guys. Do not just talk about going down. You need to tell the client that sometimes you can go down, but more importantly, you can go right the way up as time goes on. You can stop and start. If life's ensuing, you got a wedding, you're moving jobs, you're moving countries, that's no problem. I had a client recently moved to Singapore. He was based here. He was so stressed getting containers full of all the stuff, moving six of the family members over to Singapore. I was doing a review of him, and he was like getting his, all like stressed out about his payments. I was like, relax, sign this letter. I'm gonna pause payments for 3 months. You can backdate them later if you want, but get over to Singapore, get the family settled, get your bank accounts all set up. Don't worry about this, I'll manage it. Let's speak when you're on the other side. That client was there 6 weeks later. He said, Niall, I'm all set up. Move's gone all well. Let's get this up and running. Really, really easy to pause this. You can do this for maximum 12 months at a time. Okay. This is a feature that I like, but also a feature that I really, really don't like. And I phrase this in a certain way, Mr. Client, because I'm telling you right now, do not be that client and come to me telling me that you're getting a boat with a friend. It's always a boat. It is. It's mental. I'm going halves on a boat with my friend. You have emergency access to this. So if in 5 years we've built up good funds in this and the roof goes back at home, we need to liquidate £3,000 because something's gone on in your home, or whatever that may be, a medical emergency, something that's a real emergency, we can have access to this. So it's unlike a pension, which we know, we went through it, you've got 60k in a pension over here, we know that there's no chance that you can access that unless you were given 6 months to live, and sometimes they can still reject that from a trustee point of view. With these savings plans, after time, you have access. Now, all of these features come after the IP, which is the initial period, or the establishment period as they refer to it now. So I've got a diagram that I use for this, Mr. Klein. So with this policy, you're obviously 50, retiring at 65. We're looking at a 15-year term. On 15 years, the first 18 months, which is the IP, is locked in until maturity. You're not touching this. That is never coming out of this policy before your 65th birthday. But everything that we accumulate outside, this is your emergency access. Okay? And this is the part that, if there's an emergency, we can access out. Realistically, clients, I very rarely do I have clients pulling out of emergency access. It's because we're not over committing ourselves. Start small with this. Start small, just get something up and running, but I want to keep liquidity in other areas, yeah? Keep enough money in the bank so that if there is an emergency, we've got cash in the bank. We're not going to our pension. Yeah, I very, very, very rarely have clients coming to me and ask me for money out of this. It's because I've given them liquidity in other areas of their portfolio. Yeah? Really, really important though, client. This is staying in until the end. So let's go again, so you can see here that if there's, at year 5, call it, you said, no, there has been a catastrophe, you'd be able to take all of this area if you wanted to. But again, really rarely happens, but it's good feature for you to know that you've got in this. Questions on that?
When you said that area, you're talking about the initial.
Emergency access, that's locked in.
Yeah.
So you look at all of my face-to-face, you've got that in there.
Okay.
There's no, you didn't tell me about the initial period, yeah? It's really important that you understand that. And if a client goes, I'm not, you've got to really look at that client in the face and go, if you're not prepared to save for the next 18 months, and we're talking about your retirement, I don't want you as a client. Yeah, you've told me that you've got 20,000 dirhams a month. I'm talking about starting with 3,000 dirham a month. Yeah, you're still gonna, we'll speak about what we're gonna do with the rest of the liquidity at a later stage. You need to get something small ticking over, right? Yeah, what's 18 months? You've got a massive shortfall here. Clients get, and look, clients sometimes will get a little bit, 18 months, what if I lose my job? Everything. Again, that's why we have parameters in place that they've got to have certain money in the bank. Yeah, so a lot of times someone says, well, what if I lose my job? Well, okay, yep, it's always a concern here, but how long are you going to be out of work? If someone's out of work for more than 3 months, it's because they don't want to be in work. That's just the facts of the matter. Yeah, you will find jobs. It's not, especially if someone's out here, they've been vetted, they have good experience, like, you're gonna get work. So again, that's why we start really small. You've got $80,000 in the bank. You just feed a little bit that in to cover that in the first 18 months, should you want to. If they have an issue with this, Hansard, have a savings plan option, in which this can be paid for in its entirety up front. Okay? It's an option in there, which some clients really, really like.
And backdated if they want to do a little lump sum, 18 months, I think.
What do you mean?
So if someone wants to, we can't do a regular pay in a lump sum at the start, but with Hansard you can backdate 18 months, can't you?
But yeah, you can just start it with the whole initial period, yeah. But in terms of backdating, okay, so that is true. I wasn't going to say this because it can lead to unscrupulous financial advisors. Yeah, is that basically if you do that 15-year of a Hansard, yeah, you're doing a 15-year term, but then you're paying 18 months, it actually becomes a 17-year or a 16.5-year term. Because they've still got 15 years to play, right? You're just dumping in right now. So the term effectively, and you get, if you imagine with regular savings accounts, they look at the total contributions. Try and use the word contributions as well, not premiums. Contributions. Premium's a bit like premium. But do you get what I mean with the Hansard? Yeah, so basically they look at the total amount due. So if you're starting with a lump sum and are going to pay £1,000 a month in for the next 15 years, then the total amount that's due to the policy essentially is 16.5 years. So you get paid higher. But again, it's really good. I've got quite a few clients who've done that. Not quite a few. Like sometimes it makes sense because they've got cash there. They don't want the rigidness of the initial period. Yeah, look, I'm happy to start this with 20,000 or whatever it is, and then we've got full flexibility should anything happen.
Now the stop and start, is it only for 12 months or 24 months?
Certainly with Royal London, it's 12 months. They could go 12 months, pay one contribution, and then turn it off again for 12 months. They can do that in perpetuity if they really, really wanted to. I'm not too sure about all of the providers across the board. There might be some which you can do for 24 months.
And regarding the initial period, some clients ask, okay, why is it only 18 months and why do they keep that locked in until the end of the term, since we have access to the remaining months? What will you say to that? Just asking, normal clients trying to figure out these things.
It's just the way that they're structured. In reality, this pays our fees.
Yeah.
Yeah. A lot of fees come from this, which I'll explain that. You say, look, it's to pay for fees and to make sure there is money for fees in the lifetime of the policy. Otherwise, you could have companies coming up setting a lot of these. There's no IP. They do a lot of work. These are really, which I'm about to get on, really tax efficient for a number of reasons that people don't understand in the long term, which can be really, really beneficial to you and your family. Yeah, these aren't arguably simple investment accounts. Yeah, simple investment accounts, you can't just pay in by credit card. There's a lot of features built into this which make these plans really good for certain people. And if they didn't have this, you'd just have clients, okay, I want to set this up. In fact, let me close it down. Let me set it up, let me close it down. You put that across a company like Royal London, who've got over 200,000 clients and 24 billion under management. They would need to employ a team of 100 just to mess around with admin. So that's why there's a period where these stay in until the end. Yeah, it's because these are for serious investors who want long-term savings in tax-efficient pots. The next couple of points, so after the IP, again, kind of spend a bit of time on that. Yeah, and again, you might want to listen back to this or sit down with your managers and actually say, look, just take me through how you explain this, because that will look, Claire will do one differently, Reese will do one differently, all the managers will do one differently here. So just get a feel for it. Watch this video back. Like all kind of processes, you've got to just find your own way which works for you. Yeah. But again, just really kind of try and nail that down for when you're looking at savings plans. I'm going to talk about the next three things together. These are secure, these are confidential, and these are highly tax efficient. And the reason I group these together is because it is all due to the jurisdiction that we hold these in. Yeah, so these are all held in the Isle of Man. So extremely, extremely high levels of security. In the Isle of Man, they actually have government-backed investor protection. So it's the reason why there's not millions in the Isle of Man or in the Channel Islands, because it's not just them, it's Guernsey, it's Jersey. There's a reason why there's not millions there, not billions, but there's trillions in these jurisdictions. It's because these have got the highest level of protection for investors. Yeah, these are government backed. So let's say your underlying company were to go bust, which is really, really rare, because the companies that we use to set these up are not like banks. We know what happened in 2008, and we know what happens with all of our money every single month. It goes in to Emirates NBD, they're then giving it to developers, to people as personal loans and making money on your money. These do not do that. They simply hold the funds. Yeah, they give you a platform in which you can pay into. They'll give you valuations. They give you a fund choice. When you want to draw it, they will draw it. They will pay you. When you want to pass this on to a loved one, when you want to wrap this in trust, when you want to do anything with your pot, you can do that. Yeah, that's what they do. If you go onto a lot of these life companies, balance sheets, which a lot of them are public companies, you can actually see the assets of all their client money on the balance sheet. Okay? If something were to happen to one of these, the government in the Channel Islands will repay typically up to 90% of whatever is in your pot. So you can imagine someone who's, let's say you've got someone who might have money in a European bank or in a UK bank to the tune of £250,000, and someone who has £250,000 in the Isle of Man. In the UK, I'm not too sure what it is in the States, maybe you could shed some light on that, but if that bank goes bust, i.e. what happened in 2008, 90 sterling's protected. The rest is at risk. And I don't know how you feel about the British government right now, or European governments. I would be writing a lot of that off if something were to happen to that bank. In these places, you've got 90% protection. Okay? They're extremely confidential. The only people that can look at this are me, you, and the life company. Yeah, unless you're under serious investigation by the IRS, HMRC, or Interpol, yeah, you're good in terms of no one's going to be knowing about this pot. Yeah?
I looked it up. It's 250K.
250K, okay.
Yeah.
Per account.
Per account, per ownership.
Yeah.
So
Yeah.
you could have a single account and then a joint account, and they're both 250.
So again, American, imagine you got $1 million, you're like, well,
Yeah.
again, it's like you're talking about doomsday here. Say, but it's just nice to have that little bit of protection. Lastly is tax efficiency. Now, before I go into this point, let me tell you right now, there is no such thing anymore as tax havens, Mr. Client. Miss Client, sorry, I've been Miss Client. Yeah, there isn't. Everyone's talking to each other now. There's no such thing as squirreling your money away and not telling the tax man. That would be ludicrous. Yeah, you will damage so much hard work if you try and dodge tax or not tell the tax man about things. The reason why these are so efficient is because the Isle of Man has more double taxation agreements than any other jurisdiction globally. So what that means is that you're never taxed twice. Tax efficient. Yeah, it's set out. If you live in Italy and you have an Isle of Man policy and you're drawing X, the tax is DTA. Look, that's what it's taxed at. Go on, you know, it's very, very clear cut, which is why what we see as tax efficient. There's no question marks around this. As a rule of thumb, let's say you've put in 500K and you've got 200K worth of growth. Rule of thumb, it will change from jurisdiction to jurisdiction. Your capital is tax-free, and that's nothing really special. Yeah? You've paid your tax already. This is post-tax income, no matter what. Even if you're here, obviously we actually do have a tax rate here. The tax rate's just zero. If you go back to the UK, or you're in the States, or you're in Europe, and you're paying into this, well, you're going to be taxed first if it's coming from your income. Yeah? So it's really, really nice for Middle Eastern clients to squirrel away a lot of tax-free income.
But you will pay tax on the growth.
When you come to withdraw it, yes. Yeah, so when on withdrawals, it'll be tax-free, but also it's fairly universal. Yeah, there are some exceptions, but you get what's called gross roll-up, which means during the lifetime of the policy, let's say you make a gain, you don't need to put that on your tax return. Yeah, you can year on year build it up and you attain gross roll-up within the policy. There's some jurisdictions which do look to say, actually, you need to tell us what the value is at the beginning of the tax year and at the end, and then whatever it's grown by, you'll pay your marginal rate of capital gains tax on that amount. Okay. Any questions on that?
What do you do whenever actually someone asks roughly what return now? I mean, this is great.
I just get up the DeVere portal and go, model portfolios, what do you want? What should we go for? Should we go balanced? Should we go moderate growth or growth? I'd say 15 years, we're kind of at a dip. Let's get exposure to either moderate growth or growth. We're not touching this. Yeah, when you're managing investments, you're not really, as long as you're not going into weird and wacky areas with investments, you're not managing the investments, you're managing time. That's really, really a key point that I speak to clients about. Yeah. What do we know? What do we know that markets do over a 20-year period?
Generally go up.
They kind of go up, exactly. But what don't they do? They don't do that. Yeah, they're going to go like this. Yeah, oh, COVID, oh, recovery, oh, Putin's rolled in, oh, this was fucking awful, and now we're back up here. Yeah, we're managing time. Let's say that was over a 20-year period. This, you know, we're looking at cycles. That's a cycle, that's a cycle, that's a cycle. This has been a cycle, and now we're going into the next cycle. So you really only manage these towards the end. Yeah, when you get into the business end of things, Mr. Client, probably the last 30, 20% of this, where are we? Yeah, if I had some clients' policies maturing at the end of 2020, 2021, 2022, yeah, I would have been like, whoa, we're not liquidating. You can just see markets had a massive pullback, 6 months we're down 20%. Look, we've been working together for years. It happened in COVID. It happened in 2008 when Trump was going into it with China. It happened in 2018. It happened in 2008. It happened in 2000. It happened in 1987. History just repeats its stuff. Stuff goes up, it goes down. It cycles. We manage time. Yeah, so in terms of the underlying investment, I would be going growth right now because it feels like we're going into that kind of next cycle. But then if you look at the growth, since we can backdate models until 2012, balance has been getting, give or take, 5.5% to 6%. Moderate growth has been getting 6 to 7.5%, and the growth model has been getting spot on in terms of what it needs to, in and around in and around 7 to 7.5% year on year. But we've got all of that at our fingertips, and when you're doing meetings, whip out those model portfolios. They're really, really good. Has everyone got onto the DVAN portals and you use that? Has everyone? They're really good. Come grab me, I'll take you through it. There's loads of stuff you can do, and it looks like you can generate really good reports at a click of a button. So that's what I'll be doing, Mike. Just saying, well, look, like when I'm going into clients right now, like any kind of pension management or any cash, I look the client in the eye and go, I do not manage your money. Of course I don't. By the time me and you get in a room together and get our schedules together, it's already too late. Yeah, we offset this to our asset management team, show them the portal. We've got a team of 20 plus people working, so some of them are working 6 days a week, who are managing the money closely. We've got Mercer in the office, we got Columbia Thread Needle, we got Guinness. They are, let me tell you right now, they are way better than me, and they're certainly way better than me and you with our time schedules, getting into rooms and making changes. So we'll always offset it to the guys in London. Okay, so last couple of points. I think these are more surrounding ongoing servicing. So, or things that may come later down the line. Number one is that you can add beneficiaries. Yeah? Now these come with a 1%, it's a bit laughable, it's just the way that these are structured. These come with an element of 1% insurance with your policy. It means that if anything happens to you, your beneficiaries will receive 101% of the plan value if something happens to you. Yeah? You can add up to 4. They've got to be of at least 18 years of age. Yeah? If you don't have anyone 18, or you want to set this up for your child who's 14, no problem. What you would do is you can appoint someone to be almost like the protector, like a family member, or you can even appoint a corporate, which will cost you a little bit more money, but typically clients will choose their auntie, their brother, wife, or child who's of age. But you can add these really easily, and it makes sure that when you pass away, There's no, oh, where's dad's money, where's mum's money, yeah, beneficiaries are getting contacted, okay? Within these policies, we can switch between investments for the lifetime without any cost. So you have free switching. So just to give you an example, when we put this together with the team in London, yeah, they're going to have different stuff. When I used to set these up before, we didn't have all the asset management team and all the models in London. But I would just go, you know, because some of you might not want to use those in the regs. I would always use the DVAM stuff without a shadow of doubt. Yeah, it's easy to track, it's nice, it's clean, it's in-house. We've got all the data like a click of a button. Yeah, but let's say, for instance, in the next year there's an energy crisis. We see all the energy stuff go through the floor. I'm going to come out to you in a review and be like, look, let's switch in to some energy. You're going to say to me, what are you talking about, Niall? Have you seen yet the news? I said, yeah, that's why we're going to go into it. So we're going to take out a little bit of healthcare and we're going to add in some energy because it's really low. So let's start allocating $1,000 a month to stuff that's really at the bottom, because we know that energy will naturally come back up. So whenever I come and do that to you, it's really important for you to understand there isn't an ulterior motive. Every switch is free. There's no bid offer spread, there's no entry or exit charge. This is a free process. Really, really good for certain clients, especially towards the back end when we see some serious wealth build up in one of these. Yeah, and we're switching out $20,000, $30,000. If you're in a policy that sometimes there can be a dealing fee, there can be a bid offer spread, there can be an entry or exit charge. Those savings down the line can be huge. Whether you like it or not, me and you have got to sit down quarterly. Yeah, I'm going to be asking you, do we need this, do we need this? Is everything okay? Is there been an emergency? Do you need me to go over any of this? Do we need any insurance? Me and you have got to sit down every single quarter. If we go 2 quarters, I really start panicking and all my systems start blinking. So me and you, even if it's a 10-15 minute catch up, I know some clients say, no, I get it. Yeah, it's fine, I don't need it. We have to do this. On these reviews, I don't just see this as, this is your plan, it's gone sideways, see you later. I actually use these for the first 2 years as educational sessions for you. So every time we sit down, I'm going to teach you something about this horrible thing we call finance. Whether that's what an equity is, whether that's what interest rates are, whether that's what inflation looks like, whatever it may be. I've got, as you can see, I've got loads of diagrams, I've got them for everything, but I want to be educating you. After 2 years of working with me, none of my clients need me. Let me tell you that right now, and that is a fact. No clients need me. Yeah, because I educate myself out of a job. Yeah, so after 2 years, my clients are working with me and paying me because they want to, not because they have no idea of what they're doing. So after 2 years, you're going to be so much more informed. And for me, as your advisor, yeah, I'll talk about this stuff, but in my opinion, once it's set up, just leave that. You set this up, you're going to be considerably better off by the time you get to retirement than if you didn't. And this is for me to educate you, yeah, and get you up to speed and comfortable with investing. On day one, you're also going to get online access, and you're going to get the DeVere app, which you have a lovely little picture of my face in the top left-hand corner. You'll see your portfolio performance. It's got a little tab on news, but again, it's just something that you can always click a button and go and see your daily valuation. Then the last thing as well, which I'll take you through on the next meeting, it's really important to understand that these have bonuses and charges. Now, with both, when I'm going to show you some of these policies, you've got here, come and join us today, big shiny bonus of $1,500. And if you put in a certain amount, we're going to give you more. We're going to uplift your monthly income. So if you put in 1,000, we're going to actually buy $1,010 worth of stuff. And then if you stay with us for a certain period of time, at the end, we're going to chuck you 4% on top. Yeah? Let me tell you right now, they're giving you with one hand and they're taking with the other. Yeah? So like there's bonuses and charges. What my job is to do, and I'll show you this, is I want to show you the total expense ratio. Yeah? On our next meeting, which is just fancy jargon, which I know I've used quite a lot of over the last hour, for break-even point. What do you need to grow this pot by every single year to pay for everything? That's the main thing that matters to you. Because bonuses and charges are tiered. Like I said, the bonuses you've got like one at the beginning, one throughout, and one at the end. And then with the charges, it's actually quite similar. You've kind of got you've got an initial period charge, you've got like an admin charge, which is like minimal, which helps with all your online access, and then you've got a charge for like an ongoing management charge for all the little funds in there to make sure Royal London are covering and capping what the charges are on the investments. So they're both tiered, and I'll explain those next week. But the main thing is that I want a 1.5 to 2.6 to 2.7% target. That's the average cost of my client portfolios. If you get anything into 3.5%, I'm going back to the drawing board / I'm not even going to show you. Because for me, if I can't get you somewhere within that sweet spot, I'm going to go back to the market and find something else. Questions?